Hi guys, this is Investing with JYK and I'm Yao Kai. So today we'll discuss another uranium miner that's currently producing. It's EnergyFuels. The ticker is UUUU in the US. So as always, we should first start looking at their asset. Right, so here is a list of their assets, their mines. You got these 0.1% underground grade, right? If you remember, chemical had something about 10%. This is 0.1, so that's 100 times difference. And the amount of pounds, here you got 18 million pounds. In the MacArthur River alone, it's like 360 million pounds. In fact, if you add all their, including their inferred resources, not just measured and indicated, not just probable and proved. So these are actually probable. These are not proved. You add everything up. These guys have something. Let's see. So this is vanadium. You got 18 here, and you got something like 25. So that's 43 plus 27 is 70. We got like 70 million pounds, and that's it. They're tiny. They're compared to chemical. But then if you compare to any bunch of other companies, they're actually not that small. And as they said here themselves, let's go to the page that I want to go. Yeah, they say they have about 85 million. Okay, I might have made a mistake adding it up, but it's a very small amount. And then if you look at these grades, these are ISRs. So ISRs are called in situ recovery. So essentially, you just pump oxygenated water plus some acid into, or alkaline, either way, into a uranium containing ore body that has to be permeable, and then you have, like, on top and at the bottom you have impermeable rock, and then you've got in the middle section you got like permeable rock, which is uranium, which contains uranium. You pump the oxygenated alkaline or acid down one well, and then you get them out the other well. When uranium reacts with oxygen, it becomes soluble in acid and alkaline. So that's how they do this stuff. So it's fairly cheap because you don't have to dig up anything, right? So it's a fairly cheap way to deal with a low grade uranium ores. And in fact, these, you may think these are low, right? These are like 0.14, 0.15, 0.06, 0.06, all that stuff. These are not actually very low. A lot of these, so the in situ recovery mines can be made profitable, even economical, even at 0.05 or something like that. So these are not terribly low, but the problem with in situ recovery is obviously that it's a bit like shale oil. So you get a huge burst of uranium out, and then the production will just steadily decline, and you have to keep expanding your well field in order to maintain the production. But overall, it's still a fairly cheap way of doing it. And then they have these conventional properties. I mean, this is just horrible. 0.5%, right? What are we getting? You actually have to dig conventional property. You actually have to dig up the ore. So at 0.5%, you're looking at 50 kilos of uranium per ton. So 2 pounds. So you get 100 sorry, not 50 kilos, 5 kilos, right? So it's 1,000 times 1,000 times 0.5%. This is 5 kilos. Pounds, sorry, kilos, 5 kilos to pounds, so 11 pounds, and as we said, 11 times 20, you get $220 per pound, per ton of ore, and compare that to the chemical one, which are thousands of dollars per ton. This is quite bad, but you deal with what you get. These guys operate in the U.S., and in the U.S. we don't have the fantastic ore bodies that you find in Athabasca Basin. But on the other hand, you don't have to build everything in U.S. because all the roads are mostly connected. You get electricity in most of the places. In Athabasca, there's basically you can't get there by car. You have to ship everything by plane. And the thing freezes solid in the winter and becomes a mush in the summer. So it's like, so it has its own advantages. But okay, so that's what you see with their assets, and then let's look at their financial situation. Their financial situation should be, we should be able to find it. Oh, condensed, consolidated. All right, here we go. So they also sell uranium, and you can see the sales have gone down a lot. They've shut down some mines. They have also yeah, they've shut down some production basically. So that's how the uranium concentrate production is much lower. And they're losing money, as we can see. And they are actually losing quite a bit of money. They lose $5 million per quarter, right? So in this 9 months, they lost $20 million. For chemical, that's nothing. Chemical has $350 million just in cash. This stuff is slightly different. So if you look at it, they have $20 million in cash. Yay! Their entire current asset, including inventory, is $41 million. So you may look at this and you'd be like, okay, so if they lose $4 million in a quarter, and then they have $40 million total, you're going to end up with 10 quarters and you're going to die. That's 2 years and a half, right? That could be a worry. But let's look at their cash flow. So, cash flow from operations is -5. So they actually lose more than it's shown in the profit statement. Last year they lost $14 million. Okay, so yeah, these guys are in pretty bad situation, and 10 quarters or less they will run out of money. But they probably won't. The reason is that this guy is a horrible offender of share dilution. They have issued so many shares. It's beyond imagination. Right, so let me show you what they did. So this is one reason I really hate this company. But it's really cheap. Right? For the amount of uranium they have, they're really cheap. But it's just okay. So before I pass too many judgments, let's just take a look. I think this is called something like change in shareholder. All right, sorry, here, shareholder equity. Nope, change in share. Ugh, bad. Sorry, let's take a look. What is the name? Statement of changes in equity. Okay. Come on. Oh. This is so hopeless. You change your name. Consolidated balance sheets. Alright, let's find that first. How is this possible? Okay, let's find the balance sheet. Sorry about this. Just want the balance sheet. Why is this so difficult? Ugh. See what we have. $2015. Actually, we can just look at here. Balance sheet. Oh my god. Right, here we go. Changes in equity. Oh, it's my computer that's being slow. Okay, here we go. So in December 2012, number of shares 13 million, right? 13 million. By the time of September 2017, you're looking at some insane numbers here. Almost 72 million shares. What does that mean? That means for every single share, the thing has issued 4.3 shares for every single existing share back in 2012. Okay, so they basically just keep diluting. They keep issuing new shares to get more cash to either survive or buy stuff. So whatever they did, if you keep on issuing shares and you actually got more uranium in the ground, sure, if one share used to equate to 1 pound of uranium, maybe that still works, right? Because if you look at 2017, September 30th, it's 72 million shares, and then at that point, this thing had about, according to them, in their November 7th presentation, they have 85 million measured and indicated uranium. So it's about 1-to-1. Right? So if back in 2012 they only had 13 million pounds, then it probably made sense. But no, I was looking at their actually it was quite hard to find their thing. So they had a discussion I could only find it dated to December 31st, 2013. That was discussion properties. Right? So mining projects, summary resource, page 29. So let's go to page 29. There you go. Okay, let's add up their probable and measured and indicated. So 18.18542 plus measured and indicated total is 1369 plus 85,949. So, surprise, they had more uranium, right? They had more uranium back then and more shares now. So this thing has gone completely insane in diluting their shares, and each share now represents a lot less uranium than they used to. But it is a very cheap company, as you can see here, which they didn't lie. Per pound of uranium, they're still much cheaper than any other company that you can buy. So that is your risk. And then the other thing I checked is if uranium price increase, what are their sensitivities? From what I see, their contracts are expiring. So this will require a little bit of digging again. They had, discussion. Yeah, there we go. So they had 320,000 pounds that's under long-term contracts, right? And then that's a fairly small portion of their production, actually. So they delivered so much, but their production is actually much higher. They can produce up to millions of pounds. Their Nichols Ranch ISR has like 2 million pounds rated, like permitted to 2 million pounds or something. So it's a small portion. So they are actually fairly sensitive to the rise of uranium price. And then you can see here, so they say, yeah, they expect it to produce so much, but they can actually increase this stuff. And they only expect to deliver 200,000 pounds of uranium oxide for under long-term contract. So that is a difference. That is essentially the picture of this company. You got okay assets, not as big as chemical. The grades are significantly lower. They have ISR instead of, they have some ISR and some actual conventional mining, but all that is in United States, and they have access to a good infrastructure, mostly roads and power. They dilute like crazy. They end up with less uranium now than they had in 2013, and a lot more shares. So if you want to buy this, just know that they probably dilute it again. Oh, one more thing. So one funny thing that I found was that in 2015, right? In 2015, this is November 2015, somewhere in here. They bought uraners for a certain amount of money. So that's another uranium mining company, right? So that was reflected in here. So if you look at the share structure, so change in equity, changes in equity. So okay. So let's see how much they paid for this. So they issued a bunch of shares, 25 million in fact, to buy uraners. Right, so for 100, so that was equivalent to $105 million back then. So what did they get for uraners? They actually got all the ISR things. So that was in, oops. So the ones that they got was in description of business risk factors. Description public development. Sorry about that. Yeah, it's those 2 pages that always okay. So all these came from uraners. Right, so measured and indicated, this is about 20 million pounds, a little less. And they paid 105 million for that. Divided by 20, they paid $5 per pound. More than $5 per pound for the uranium on the ground. And they did something stupid again in recently. If you look at News and PR, just very recently. Okay, so they sell something for 5.39 million, right? So they sell this Reno Creek, actually. See, they sold the Reno Creek stuff that they had for 5.39 million. All right, so let's go back and look at what that means. That's the Reno Creek they hold, which means you're looking at 2.782 million pounds plus 1511, so measured and indicated, right? So 4.3 million pounds, right? And then they sold it for $5.39 million. Right, sorry. So 5.39. So they sold each pound of uranium for $1.25. So they bought these things in 2015 for 5.25. Then they sold it in 2017 for a portion of it for 1.25. This is crazy. This is just crazy. So I think this is a very badly managed company. They are really cheap, probably for a reason. And then they have production capacity, so risky bet. Personally, I don't like them, but I have a small holding on these guys. Yeah. So we'll discuss another one, another uranium miner in the future. Thanks for the patience.